Welcome to my channel. I'm Scott, and in this video I'm going to walk you through a process of valuing Boeing stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 126 billion market cap. They're trading at $207 a share, and they have 611 million shares outstanding. I'm sure you knew this already, but their main source of revenue is manufacturing and servicing planes and defense products. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Things were really rough in 2020, negative 20 billion. It did get better in 2021, negative 4 billion, but it's finally positive in 2022, 2.3 billion. And they did complete their 2023 fiscal year, and it was double 2022, 4.4 billion. So things are moving in the right direction. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also really bad in 2020, but it improves each year. It goes from negative 12 billion to negative 2.2 billion. They have lots of write-downs. And the way you know this is because they have positive free cash flow with negative net income. And 95% of the time, the reason for that is write-downs, like goodwill impairment or asset impairments. It is possible it's not a large asset impairment and they took a big hit on taxes. But with a company like this, with a company with so much fixed assets, it's pretty likely it's an impairment. Revenue is a sales for the company, and that looks really good. It grows from 58 billion to 78 billion. A really nice growth of 17% from 2022 to 2023. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 170 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $149 billion. We divide that by 611 million shares. And we get a calculated stock price at $245. They're trading at $207, so they're trading at a 15% discount. It's a buy according to the model. Their future revenue and free cash flow targets are supposed to be fairly aggressive, reaching 11 billion by 2027. I definitely think that's doable because they've hit these levels in the past. There are 68 companies in the same industry as Boeing, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 1.5 billion. These are the investments in property, plant, and equipment. RTX spends the most, then Northrop Grumman, then Lockheed Martin, and they're fourth. We can't look at their debt to equity ratio because they have negative equity, which means their liabilities are higher than their assets. They do not pay a dividend. They generate a lot of free cash flow. Third on this list, Lockheed is number 1. They rank second in market cap, a little behind RTX. We can't look at their price to book since they have negative equity. We can't look at their PE since they have negative earnings. Their price to free cash flow and price to sales are a lot better than the average, a little better than the median, and they generate more revenue than anybody on this list, 78 billion, 10 billion more than RTX. But they're not growing. Their 5-year annual revenue growth rate is negative 5%. In the past 4 years, they have been growing a lot, but pre-2020, their revenue was much higher than it currently is. Especially in 2018, it was over 100 billion. Now it's down to 78 billion. But they're such a big and powerful company, I think it's pretty likely they're going to get back up to these levels again. Maybe not this year, but probably next year or 2026, they'll break through 100 billion. They recently released their 10K. This is for 2023. We'll start with their income statement. It shows us 2023, 2022, and 2021. Revenue is up each year from 62 billion to 67 billion to 78 billion. It's a nice steady growth, but still a lot lower than 2019 levels of 100 billion. Product sales, 66 billion. That's gone up a lot each year. Services, 12 billion. Let's see if they give a further breakdown of the revenue. Of the $78 billion of revenue, $34 billion is airplanes, $25 billion in defense, space and security, global services $19 billion. Airlines make the most money in services because they have the highest margin. Here's a breakdown of the revenue by location. Europe is number 1 at $10.5 billion, Asia $10 billion, Middle East $6.6 billion, Oceania $1.7 billion. Oceania is Australia. Canada $1.3 billion, our friends to the north. $800 million Africa. Latin America, Caribbean, and other $1.5 billion. That's their international revenue. But a bulk of their revenue, more than half their revenue, is in the US, $45 billion. Let's go back to the income statement. We'll look at their expenses. You can see they lose money from airplanes. Revenue of $34 billion. An operating loss of $1.6 billion. Same thing in defense, space, and security. Revenue of $25 billion, but a loss of $1.8 billion. The only place they make money is services. $19 billion of revenue, $3.3 billion of operating income. So why don't they just do services and scrap making planes? Well, the only way they can service the planes is if they make them. And that's why during COVID, they were losing so much money. Because planes were not flying nearly as much as in prior years, so they didn't need much service. But you can see service profit is going up. It was $2 billion in 2021. It's up about 65% to $3.3 billion in 2023. So they do have an operating loss for 2023. It's really small, $70 million. Much better than the prior 2 years, an operating loss of about $3 billion. If you're not sure what FAS/CAS service cost adjustment is, that's the difference between the pension expense for FAS, Financial Accounting Standards. CAS is GAAP and US government cost accounting standards. So their total loss from operations is $800 million. They do have other income of $1.2 billion, interest of $2.5 billion. So loss before taxes of $2 billion. They paid $237 million of taxes, a net loss of $2.2 billion, which is better than last year of $5 billion and the year before a loss of $4.3 billion. Here's a different view of their income statement. Revenue $78 billion, cost of revenue $70 billion. So they do have a gross profit of $7.7 billion, double last year's. G&A expenses $5.2 billion, R&D $3.4 billion. So their loss from operations is $773 million. It's just a different breakout of the numbers, but the operating loss has to be the same. So their loss per share is $3.67, better than prior years. It looks like they are adding shares. They had 588 million shares outstanding in 2021, 595 million in 2022, 606 million in 2023. So you generally want to see shares go down, not up. But I guess they needed funds to pay their expenses or for acquisition, so they added shares. Let's take a look at their balance sheet. This is 2023 and 2022. Current assets of $109 billion. Current liabilities of $96 billion, so their current ratio is above 1. Cash, $13 billion. Short-term investments, $3 billion. Accounts receivables, how much money other companies owe them when they sell on credit, $2.6 billion. Here is a breakdown of the $2.6 billion. $1 billion from the government. Global services, $1.5 billion. Then a small amount in defense, space, and security, $160 million. So global services, defense, space, and security are regular U.S. companies, non-government U.S. companies, or possibly governments outside the U.S. $8.3 billion of unbilled receivables. Of the $8.3 billion of unbilled receivables, $6.6 billion should be collected within a year, $1.8 billion beyond 1 year. Unbilled revenue is recognized revenue, but Boeing hasn't billed for that yet. They did earn the revenue on their income statement by delivering the product or providing the service, but they have not invoiced the customer yet. It's different than unearned revenue. Unearned revenue is a liability where Boeing receives cash before delivering the product or service. This is kind of like the opposite. They did not receive the cash, but they have delivered the product or service. I know it's kind of confusing. It's a lot of accounting jargon, but it's at least good to understand this stuff on a high level. And they have a ton of inventory, 79 billion, which is much more than half their revenue. And most of that is aircraft, 69 billion. 9.5 billion of spare parts. Let's look at their non-current assets. Assets that should be converted to cash beyond 1 year. PP&E is the biggest, 10.7 billion. Here's a breakdown of the PP&E. 15 billion of buildings and land improvements, 16 billion of machinery. The gross value is 33 billion. They depreciated 22 billion, so the book value is 10.7 billion. 8 billion of goodwill. Of the 8 billion of goodwill, 1.3 billion is tied to companies they acquired in commercial airplanes, 3.2 billion in defense, space and securities, 3.5 billion in global services. Their biggest acquisition was in 1996 when they acquired McDonnell Douglas for 13.3 billion. And their largest sale, which is the opposite of an acquisition, is when they sold Spirit for 375 million. Let's go back to the balance sheet. They have 2 billion of intangible assets. They have 1 billion of investments. So total assets 137 billion, same as last year. Total liabilities 154 billion. Their biggest is advances and progress billings, 56 billion. And they talk about it right here. Advances and progress billings increased from 53 billion to 56 billion. Mainly driven by advance orders at BCA, partially offset by revenue recognized at BDS. You may know what this is, but BCA is Boeing commercial airplanes, and BDS is Boeing defense, space, and security. This is like unearned revenue when they receive cash but haven't delivered the product or service yet. They have a good amount of long-term debt, 47 billion. So when you take their assets minus their liabilities, you have a deficit of 17 billion. Because their assets, 137 billion, are less than their liabilities, 154 billion. But you should look at treasury stock. They have negative 49 billion of treasury stock. So they bought back 49 billion of their own stock. If they didn't buy back so much stock, they would have positive equity. There are two main ways for a company to give back to its shareholders: a dividend and buying back stock. They buy back lots of stock. It's just like you when you buy stock. If a stock price is low, it's good to buy the stock. If the stock price is high, then it's better not to buy the stock or even sell your stock to make a profit. Hopefully they're buying it when it's low and selling it when it's high. And they have negative 10 billion of accumulated other comprehensive loss. You could find accumulated other comprehensive loss on their statement of owner's equity. And this dollar amount is usually unrealized losses on pension contracts or derivatives. Let's look at their statement of cash flows. The first section is operating cash flow. You start with your net loss of 2.2 billion, then you adjust for the non-cash items on the income statement. They pass through an expense of 700 million on stock-based compensation, another expense of 1.5 billion on treasury stock they put into 401ks of their employees, 1.9 billion in depreciation and amortization. Then we have to adjust for changes in working capital. So in 2023, they had an operating gain of 6 billion, 3.5 billion in 2022, and a cash loss of 3.3 billion in 2021. So this number has improved quite a bit. In their investing section, they spent 1.5 billion of PP&E. That seems to be going up a good clip each year. In their financing section, they paid back 5.2 billion of debt, and they paid 400 million of taxes on employee stock purchase plans. So in their financing section, they had a cash outflow of 5.5 billion. On 1/1/2023, they had 14.6 billion of cash. You see it says cash at the beginning of the year. And then they lost 2 billion of cash from running their business. The way you get this 1.93 billion, you sum up operating cash flow, investing cash flow, and financing cash flow. So they started the year at 14.6 billion. They lost 1.9 billion of cash. and cash at the end of the year, $12.7 billion. Remember these two numbers, $14.6 billion, $12.7 billion. Beginning cash, ending cash. Let's go back to the balance sheet, and that's what we see. The beginning cash on 1/1/2023 is $14.6 billion, because this column is 12/31/2022. And then at the end of 2023, their cash is $12.7 billion, so it matches the statement of cash flows. So on their 10K in 2024, their beginning cash will be $12.7 billion. Let's take a look at the company on Simply Wall Street. Its last price, 209, 127 billion market cap, flat in the past week, down 2% in the past year. Let's see what they say about the company. Boeing designs, develops, manufactures, sells, services, and supports commercial jetliners, military aircraft, satellites, missile defense, human space flight, and launch systems, as well as services worldwide. They operate through commercial airplanes, defense, space and security, and global services. The airplane segment develops, produces, and markets commercial jet aircraft for passenger and cargo requirements, as well as fleet support services. The defense, space, and security segment engages in the research, development, production, and modification of manned and unmanned military aircraft and weapons systems, strategic defense and intelligence systems, which include strategic missile and defense systems, command, control, communications, computers, intelligence, surveillance, and reconnaissance, cyber and information solutions, and intelligence systems. Also, satellite systems such as government and commercial satellites, and space exploration. Their global services segment offers products and services including supply chain and logistics management, engineering, maintenance and modifications, upgrades and conversions, spare parts, pilot and maintenance training systems and services, pilot and maintenance training systems and services, technical and maintenance documents, and data analytics and digital services to commercial and defense companies. They were incorporated over 100 years ago in 1916, based in Arlington, Virginia. Here's their stock price since 1990. It looks like it was about $20 back then. It ran up close to $100 in 2007. Then the Great Recession hit. It came down to the mid-30s. Then it ran up to $132 by 2016. In February 2019 at $432. Then it had a COVID crash down to about 100 in middle 2020. And it did rebound pretty quickly in 2021, about 250, came back down, then ran back up again. So it's been trading in the low 200s for several months now, about 50% below its all-time high. Simply Wall Street is really bullish on this one. They're at $500 a share. They say the stock is 58% undervalued. 29 analysts price this stock at $257. They also say it's undervalued. Their revenue is projected to grow a lot over the next few years. Their revenue for 2024 is expected to be $90 billion. 2025, $100 billion. 2026, $110 billion. Do you think it's going to hit these revenue targets? This is their free cash flow estimates. 2024, $5.2 billion. 2025, $8.8 billion. 2026, $10.8 billion. Their debt was pretty low in 2013 at $9 billion. Fairly steady for the next 8-9 years. By 2018, $11.9 billion. Then it shot way up to over $60 billion in 2020. It's come down a little bit. It's at $52 billion, but still pretty high debt levels. And their equity has gone down. They have negative equity for several years now, just like Starbucks, negative equity. And this green line is their cash. They do have a lot of cash on their balance sheet, almost $16 billion. So they can easily service their debt payments. You don't need more cash than debt. You just need to be able to service the debt. But if interest rates go up a lot and you have a lot of debt, that could be a big problem. Their dividend peaked in 2016 at 3.4%, 2019 2.3%. Then when COVID hit, they cut their dividend. They haven't paid a dividend in several years, but the forecast is for the dividend to be 1.2% by 2026, When they do bring their dividend back, then there's going to be a whole rush of buyers coming in, those dividend investors, which will push the stock price higher. Just like Meta. Meta is going to be a $1,000 stock by next year. It'll probably double in price. The CEO's annual salary is a cool $1.4 million, total compensation $22.5 million. His tenure as CEO is 4.1 years. Not too much insider activity, 2 sells and 1 buy. 57% of the company is held by institutions, 37% by the general public, and 5% by the employees. The Pennsylvania Investment Advisor, with $8 trillion of assets under management, owns 7.8% of the company, also known as Vanguard. The largest asset manager in the world in New York City, BlackRock, with over $9 trillion of assets under management, owns 6% of the company. The employees own 5.3%, Fidelity 2.7%. The New Jersey Financial Advisor, with $500 billion of assets under management, owns 1% of the company. Fisher, the Texas asset manager, with $250 billion of assets under management, owns 0.68% of the company. The Boston-based investment manager with $500 billion of assets under management, Eaton Vance, owns 0.5% of the company. Their employee count is pretty steady, 168,000 in 2013, 171,000 by the end of 2023. And the ticker trades on the New York Stock Exchange, London Stock Exchange, Mexican Bolsa, Lima Bolsa, Deutsche Börse, Swiss, Zitra, Santiago, Wiener Börse, Euro TLX, Bulgaria, Kazakhstan, Santiago, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and the NEO. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.